Well, it's good to have you with us. After clashing in recent years, investors and the Federal Reserve seem to be, for once, broadly in sync. We mentioned that we're seeing stock markets rally again today after the U.S. Fed Chair Jerome Powell and his team signaled interest rate cuts coming next year, in many ways unleashing a bullish pulse across markets, optimism that inflation pressures are easing. For more on the path ahead, let's get some insight from Dennis Lockhart, who served as the president and CEO of the Federal Reserve Bank of Atlanta from 2007 to 2017. Dennis, great to have you as always. Appreciate the time.
Thank you, John. Good morning.
For anybody who did miss some of that messaging from the U.S. Central Bank yesterday, give us your reaction to what ultimately was laid out.
Well, I think the Fed clearly signaled that 2024 will include some rate cuts. The summary of economic projections, which I think is an important way of gauging the minds of individuals on the committee, was a fairly wide range from 2 to 4 cuts. About 15 of the 19 people saw something in that range of 2 to 4 cuts. That tells me it's still early. They're discussing it. It's not a tight consensus as to how many cuts, but directionally, they're definitely moving toward rate cuts, and the market reacted because that was the expectation of the market as well. The market reacted very strongly.
Maybe I can talk a little bit about the market expectations, because it appears that in the market, and this is just it depends on how you calculate it, but Bloomberg does a pretty good job of this. I mean, it almost appears as if the market is penciling in upwards of the possibility of 6 quarter-point cuts by the Fed next year, which I guess if you measured that a certain way could ultimately be double what we seem to be getting in the messaging from the Fed right now. What do you make of that dynamic?
I think it's wishful thinking. I think the market is getting ahead of the Fed, as the markets often do. I just don't see it in the cards. I think they will continue to use Powell's phrase, to proceed carefully, which means that I think they're going to continue to discuss in the January meeting and the March meeting conceivably as well. I just don't think they're going to get to 6 cuts next year, unless the economy falls out of bed. Now, there are really 2 ways or 2 reasons they might cut. One is things are going very badly, in which case they might get there to 6. But the other reason is things are going well from an inflation point of view, and then they see the reason they have to be moving toward neutral and have to offset the real interest rates that would be rising in that scenario. So I think the best scenario of those 2 is things are going to go well from an inflation point of view. I just don't see the need for 6 rate cuts.
Well, I guess we'll only find out with time whether or not what feels like a disconnect once again on what the Fed is saying and what the market is believing, whether that is something that finds more common ground. It feels like for now, it's really more just the fact that the Fed really for the first time is signaling cuts ahead in 2024, which almost is a justification for some of what the market's thinking has been recently. I do want to get back to what you just talked about on the economic front, because there's this buzz going around on the idea of, quote, immaculate disinflation, the idea that inflation can fall back towards the Fed's 2% target and get there without a real hit to the economy. And you just finished a point where you highlighted, the more aggressive we see the Fed, the more likely the economy is not in the best shape. So that might be part of the other market reaction here. I mean, it's always hard to sort of quantify the exact reasoning behind the markets, but the idea that inflation's coming down, that rates could be coming down, but also that the economy is holding up relatively well. What's your general assessment on where the economy ultimately ends up?
Well, I think there's every reason to hope, just based on trends, that this immaculate disinflation, aka soft landing, is plausible. It could develop that way. I think the big issue in 2024 is at what point does the Fed sort of cross over into overdoing it, staying too long? That will be part of their calculation as they go through the meetings in 2024. But we're seeing the early stages, arguably, of a soft landing. And I would define that as no major damage to employment, continuing growth, albeit lower growth than we've seen in 2023, and disinflation moving toward 2%. That's a very nice scenario, and it's happening now. It's happened so far. I think it has a decent chance of continuing.
If the market itself, just to come back to the mood of the markets, because it's really hard to ignore the exuberance we've been seeing over the last 24 hours. If the market gets ahead ultimately of the Fed, and is there a possibility there that further complicates the Fed's job? Because that was something that came up, call it over the last 3 to 4 months, whenever you would see, the market getting excited even on the prospect of cuts. Is there a complicating factor there?
Yes, I think there is, because as Powell emphasized, it's overall financial conditions that really either weigh on the inflation rate, weigh on the economy, or stimulate in other circumstances. And the Fed only controls the short end of the interest rate financial conditions. So when the longer rates, the rates that are used for auto loans, for example, mortgages and such, when they decline, that's working against what the Fed would like to see to get inflation under control. There was an interesting question he was asked during the press conference, and in so many words, he said, we're just going to do what we think is right because we really can't control what markets do with these longer term rates.